We have three messages this week. We're going to talk about markets, we're going to talk about the US earnings season, and we're going to talk about the low interest rate environment. Message one, markets. Both the S&P 500 and the FTSE 100 have made year-to-date highs this week, which is a world away from what we saw on the 11th of February when they were making multi-year lows. What we have observed, though, is that in the rally, there's been fairly defensive behavior. Investors have been buying downside protection into the up move. So it tells me that the rally has more legs to go, especially if the economic environment remains fairly benign. Message two, the US earnings season. US earnings season started this week. It's very early days. We run into earnings season with lowered expectations. The consensus is centered on a 10% decline in earnings year on year. Now, that is a very low bar. That means that it must be quite easy to leap over that low bar. And going forward in the next 4 weeks, I would have thought that markets would remain fairly well supported as companies broadly surprise to the upside. Message three, the low interest rate environment. On Thursday, the Bank of England kept interest rates at 0.5%, which is where they have been since March of 2009. In addition, we had inflation data, which came in fairly benign. Core inflation ticked up to 1.5%, but it's not at any level that the Bank of England are going to be worried about. The key message is that we are living in a low interest rate environment. We know that more than 1/4 of global government bonds are in negative territory, which means that risk-free assets are not at risk-free valuations. So investors have to take on additional risk in order to achieve their yield target. So it could be in the form of duration risk, it could be in the form of credit risk. You could take more price volatility by investing in equity markets, or you could take on more illiquidity by investing in property and real estate. Now, obviously, we look at all these variables, we take them into consideration, we weigh up the risks against evaluations, against our objectives, and we invest accordingly.